Good afternoon, everyone. Welcome to our webinar on Unaccountable and Unaffordable, the 6th edition. I'll give just a moment here for people to join the room and we will kick this call off. I'm joined today by the report co-authors, ALEC's Executive Vice President of Policy and Chief Economist, Jonathan Williams, and our research manager here at the Center for State Fiscal Reform, Thomas Savidge. Tom, thanks for being with us today. All the way across the country in Indiana. Now that everyone's on the call, we'll go ahead and kick this off. This is, as I mentioned, our 6th edition of our publication, Unaccountable and Unaffordable, looking at the unfunded public pension liabilities across the 50 states. This year, we found that there are $8.2 trillion in unfunded liabilities in state pension plans. I'd like to now turn it over to you, Jonathan, to talk to us about why we're looking at this report, how it can be helpful for state legislators, and just some general background on what we're looking at here.
Well, thanks, Lee, and good afternoon, everybody. As always, greetings from the land of make-believe out here in Washington, D.C., where we come from. It's just such an important topic as we've been talking about here at ALEC and our Center for State Fiscal Reform on these massive unfunded pension liabilities. We've been talking about it for at least 6 years in this iteration of the report. But I did want to start out by just thanking the originator of this report, our good friend, the late Bob Williams, who recently passed away, who came to ALEC almost a decade ago with the idea that we ought to be tracking the apples to apples comparison of these massive unfunded pension liabilities across the country. As an accountant, Bob was horrified by the idea that state and local governments don't follow real accounting rules. I mean, anybody that's listened to Bob more than a minute or two has heard that story multiple times, and that if CEOs and CFOs in the private sector signed off on financial statements with the accounting used by state and local governments, they'd be in prison. That is the kind of Enron style accounting, unfortunately, that has gone on for far too long in state and local governments. And so our report cuts through some of the bad accounting and really gives an apples to apples comparison of how states are funding, or in many cases, unfortunately, not funding their unfunded pension obligations. And as we'll get to in this discussion today, I think it's so important that, it's for states, this is nearly an existential threat to state budgets and to state financial health going forward if these liabilities are not addressed. And, thankfully, it's not all doom and gloom. While we're going to talk about some big numbers, some scary numbers that we're seeing in places like California and Illinois and other states that have not managed their liabilities responsibly, we do have some great case studies that we're going to continue to show, not only from a theoretical perspective, but an actual perspective of states like Utah and Alaska and Oklahoma and my home state of Michigan that have made some real free market reforms in past years that have transitioned new hires, let's say, away from just the old defined benefit plans that were underfunded and very clunky from a logistics perspective into plans that are much more sustainable going forward. And so there's some real hope and some light at the end of the tunnel when it comes to a very discouraging problem. If you've all watched the markets over recent weeks, your 401ks may have turned into 301ks, unfortunately. And let's not think for a moment that's not happening as well in the public sector plans across the country. And who does that come back on? It comes back on taxpayers. And so something from the ALEC Center for State Fiscal Reform we always like to talk about whenever you're talking about unfunded liabilities for a state. We talk often about state competitiveness and rich states, poor states. These are not in isolation, folks. These are future tax increases that are waiting to happen that will harm the state's business environment and overall tax competitiveness if they're not handled well. And so today, I know we not only want to highlight some of the big scary numbers that are important to know about, that we're actually having an actual discussion around the real numbers on these liabilities, but then look at solution sets to get ahead of this problem before it becomes a crisis.
Well, you make a lot of great points, Jonathan, and I think it's important for us all to remember that, one, we need to make sure that we're keeping the pension promises we've made to state workers. And two, it's that all of us, you and I, taxpayers across the country, are on the hook for these unfunded liabilities. But before we dive into the results in the 6th edition, Tom, I'd like to give you a chance to sort of give your own perspective on the background of this report and really why it's important for the country.
Thanks, Lee. As Jonathan said, we we cut through a lot of the bad accounting, and what makes the Unaccountable and Unaffordable a unique report is that we are challenging those actuarial assumptions in public pension plans. We use what's called a risk-free discount rate, which measures the present value of unfunded liabilities that are owed in the future. And by doing that, we use the yield curve of the 10-year and 20-year U.S. Treasury bond, which varies from year to year because the yield changes year over year. And then to account for some of those changes, we also used a fixed discount rate of 4.5%. Now, to put those two numbers in perspective, the average, and you'll see in the report, the average discount rate used by public pension plans was about 7.5%. And as you'll see in the report, even just a slight percentage point change could mean the difference of hundreds of millions of dollars in unfunded liabilities. And we also use a couple of different metrics of measuring the health of pension systems, including total unfunded liabilities, per capita unfunded liabilities, the funding ratio, which is the measure of assets to liabilities, which, as Bob Williams always liked to say, it should be 100% funded, but even the best funded state is maybe only 70% funded, and that's Wisconsin using our numbers. And also, the unique part of the report is offering those solutions. It's like, what can states do? It can be some very scary numbers, as Jonathan mentioned, but it is definitely not a hopeless situation.
And so, Tom, if you would walk us through some of the big findings in this year's edition. Who were the biggest winners? Who were the biggest losers across the states?
Sure. So I like to start off with the bad news first. And I'll start. So with the bottom five, the largest unfunded pension liabilities in the country was California with $1.5 trillion in unfunded liabilities. Then Illinois in 49 with $533 billion, Texas with $529 billion, New York with $508 billion, and Ohio with $429 billion. And these bottom states make up about 43% of all unfunded liabilities in the United States. And of the bottom 10 states, they make up more than half of all unfunded liabilities. And, just to put this into some historical context, since the report's been issued, California has consistently had the largest unfunded liabilities in the country, and they've outpaced the state in 49th by at least $500 billion for each year that this report's been issued. And consistently, the bottom five states have made up at least 1/3 of all unfunded pension liabilities for every year that the report was issued. That being said, we also like to look at, as Lee said, the winners. And those states are Vermont, South Dakota, North Dakota, Delaware, and Wyoming. But, even the winners still have quite a sizable amount of unfunded liabilities. Vermont, in the number one spot, still is, about $14.5 billion in unfunded liabilities. It's no small number. And with that being said, too, we also like to look at what we call the most improved players in the team. And that, of course, is Alaska with, thanks to their defined contribution reforms, those unfunded liabilities have decreased. Arizona's recent reforms have helped decrease unfunded liabilities by $40 billion. Indiana's switch to a hybrid and retirement savings options have lowered unfunded liabilities. And the same with Maine in 2016, which we'll talk a bit more about those reforms a little later, but that's helped decrease unfunded liability by $500 billion as well.
Great points, Tom. And to you, Jonathan, you mentioned earlier, we've seen a couple of states over the years really have landmark reforms to their state pension plans. Walk us through a little bit of some of those states that really stand out to you and what they were able to achieve and really how they were able to do it.
Well, there's a lot of great free market success stories as we've been talking about. We alluded to some of them already, We just had the opportunity to host Governor Scott Walker at one of our academies for education reform briefly, and I had a chance to sit next to him at dinner as we were talking about his Act 10 reforms in Wisconsin. That really helped bolster, as Tom mentioned, one of the best funded pension systems in America, depending on how you look at it. I think in every year of our report, we've looked at Wisconsin as being really the gold standard. And one of the reasons why is there's a real sharing of risk, even though if they have a defined benefit component, both the taxpayers and public employees have a role to play in terms of making up unfunded liabilities. And so I think that keeps Wisconsin insulated from a lot of the politically driven investment schemes I know we want to talk about today as something in the news. You saw probably Mike Pence, Vice President Pence's editorial in the Wall Street Journal talking about how states should consider the new ALEC model policy as it relates to the radical kind of interpretation of ESG and how that's being used to have states divest or invest in politically driven causes versus long-term rates of return. But if you look at, my home state of Michigan, we have ALEC founder John Engler, who's a state legislator 50 years ago when ALEC started in 1973. He became governor, as many of you know, in the 1990s. And Michigan was the very first state to transform their pension system into more of a 401k type system where all new state employees as of the mid 1990s entered that new plan. And if you look at the studies, this once again just isn't theoretical. This is actually saving Michigan taxpayers billions of dollars in terms of unfunded liabilities that are not there, that would have been there if it wouldn't have been for those reforms in the 1990s. Our friends at the Mackinac Center for Public Policy have documented this. And so Michigan was one of the first, Alaska in 2005, Oklahoma in 2014, Utah transitioned to I think a great hybrid system with our good friend Dan Lillienquist when he was in the Utah Senate. And in fact, he kicked off the ALEC series, Keeping the Promise, and Real Government Solutions to State Pension Problems, and wrote that for us based on the Utah case study. So just off the top of the head, those are 5 or 6 states that have done things from a structural perspective, I think correctly in many cases, but then now we're seeing really the dividends of those reforms that were hard fought years ago. And now their taxpayers in their states are much better off because they took that, in some cases, difficult political lift and got those important things across the finish line.
Well, one of the states you mentioned was Alaska and the great reform that they made. But just this past session, the legislature was voting to undo those reforms. Why would a state attempt to do something like that? And how did that play out for Alaska?
Well, I think taxpayers and the pension system in Alaska dodged a major bullet in that. I think you had a piece of legislation that went through the Alaska House and was even being considered perhaps in the Alaska Senate that would have undone so many of those reforms in Alaska from 2005 that made so much progress in stopping the unfunded liabilities from growing more. And I think, to some extent, this gets into a scenario where sometimes politics, unfortunately, rears its ugly head and gets ahead of what good policy might be. And some I'm just hypothetically thinking about the scenario, it being an election year, some thinking about what they might need to do to get reelected and potentially throw out the good reforms from 15 years ago in an effort to curry favor with special interest groups that might have wanted to see that undone and to see a defined benefit plan be mandated for all new government employees, and really the 401k plan to be disallowed, if I understand how that legislation worked. Now, luckily, the cooler heads prevailed, and members of the Senate, and I know Governor Dunleavy and others said, that bill's not going anywhere. They adjourned their session, and now I think it's a big win for taxpayers, and that did not get undone. Same situation in Oklahoma, as you referred to, Lee, where I think the legislation there passed the House. The Senate did not pass that and did not concur. And so thankfully, the 401k real pension reforms are going to continue in both of those states, but a real threat, no doubt. And it wasn't just in a blue state. This is something that I think state legislators across the country need to be very acutely aware that, the politics on this issue are rough, but it's very clear based on our research and based on the research of so many others that it not only is the right thing to do, we're actually seeing real results from these reforms.
Well, staying on the topic of threats, but moving to a blue state, Tom, you and I have been talking a lot about California and some of the efforts in that state, the Golden State, where they've got $1.5 trillion in unfunded liabilities, ranked 50th in our report. They are looking to introduce a dose of politics into their pension system, CalPERS and CalSTRS. What are you seeing, Tom, out in California on that front?
Oh, yeah. So although this is the most recent venture into politically motivated investments, California is no stranger to that type of investing. And it seems to be the primary motive of investing is not providing a good investment return for the public employees. It's more about making a political statement. And it's been that way, documented for about 20 years, whether it's firearms, tobacco, or now, the latest fad, ESG, environmental, social, and governance investing. They currently have restrictions on fossil fuels, but there's a new bill, Senate Bill 1173, that would outright ban all fossil fuel investments and not allow them to renew the current investments that they have in fossil fuel companies. And that could end up costing the state billions of dollars in unfunded liabilities. And the numbers don't look great. And when you constrain investments based on non-pecuniary factors like this, it's just going to pour gas on the fire.
Well, and you used the term ESG, and I think that's a great segue to what we'd like to talk about next. ALEC has a new model policy, our State Government Employee Retirement Protection Act, that aims to strengthen the fiduciary duties of state pension plans. And so, Jonathan, why don't you connect the dots for us? ESG has been in the news a ton lately. ALEC's got this new model policy. A lot of people are talking about it. How does that tie into our 6th edition here of our new report?
Well, I think in short, as bad as these numbers look, some of your states, you're seeing huge increases in unfunded liabilities over the course of the last year. It could be much, much worse if states adopt the radical ESG motivation for investing and divesting from things based on political factors versus the sole interest of the beneficiaries of the plans, the retirees. And that's something that we at ALEC for many, many years have discussed. This isn't, while it's in the news today, and I'm glad that so many voices are talking about this overly politicized version of pension investing through radical ESG interpretation. This is something that for nearly a decade, we at ALEC and our Center for State Fiscal Reform have written about. In fact, Keeping the Promise, Keeping Politics Out of Pensions was a report 5 or 6 years ago that we put out to really show, once again, not just in theoretical objections to some of these ideas, but looking back and citing academic work, well, we've been able to show that over the course of, let's say, 50 years, a portfolio that would be hypothetically divested from all oil and gas, like Tom just talked about, like some of the ideas in California right now, versus let's say an S&P 500 type index fund, a broad-based investment portfolio, nearly 1 percentage point per year loss of returns every single year during that 50-year period on average for a fund that's divested. And so our point is, if you with your own dollars, any of us with our own dollars would like to invest or divest for any political reason that we want, that's our money. So God bless us if you want to do that. But if you want to take your interpretation and your politics and play those politics with other people's hard-earned retirement dollars, that's where we at ALEC say that's a hard no, and that's bad public policy. We hope that state lawmakers across the country pay special attention to what, let's just say, Maine did, which was the first state last year in 2021 state legislative session, voted to phase out over the next couple of years, complete divestment approach from all fossil fuels. Now, as Tom said, it may not just be fossil fuels. Pick your political enemy of the day in any state capital, right, left, or center. Whether it's gun manufacturers, whether it's others, tobacco, which is what California divested of 20 plus years ago, where it's lost billions of dollars. It's been shown, or the issue of the day with fossil fuels. I think even one of the California pension plans and one of their officials said that they would have lost billions if they would go through that approach right now. And so I think, in short, what you see now are some large numbers, some really serious problems for states when it comes to unfunded liabilities and what that means for future tax increases for your state. And if politically based investing catches on and moves from Maine and California and New York to other states, those numbers are only going to get larger. And unfortunately, there's going to be a lot of people that are going to pay the price for that.
And Tom, you've had a couple of regulatory comments that you've submitted at the federal level to talk about what some of the results are when there are these types of investments. You've talked about the rules under ERISA. How does that all apply to the states under this new model policy, or how would it apply to them?
Sure, it would would apply the same as it. So those public comments were submitted on behalf of ERISA, but as Jonathan mentioned a little earlier, ERISA does not apply to public pensions. So if public pensions were held to the same standards as private pensions, the plan managers would be in a lot of trouble right now. So the way that would apply to public pensions is that we've shown in those comments that any sort of divestment for non-pecuniary reasons just adds unnecessary risk to the plan, and you see more volatile investment returns. So you'll see huge swings up and then huge swings down. It's like the investment returns for the state of New York sort of resemble the roller coaster, the cyclone at on Coney Island. And as we've shown in these comments, we take what's called the standard deviation of the investment returns, and the higher the standard deviation, the more volatile the investment returns. And states like California and New York that have these politically motivated constraints have a way higher volatility than states like Wisconsin or Tennessee. That Wisconsin, as Jonathan mentioned earlier, has that cost sharing and risk sharing element to it. And Tennessee, their investment philosophy is just simple. They said, we want to provide the highest return at a reasonable level of risk. Nothing else constraining that. And to kind of just one more thing on that, to add to those findings, as we've mentioned in Keeping the Promise and in numerous other ALEC commentaries, ESG investing has found that, they don't actually achieve the desired outcomes that these political goals that people claim from either, engaging either in divestments or investments. And then on top of that, as Jonathan mentioned, it yields lower returns. And those findings were also confirmed in a recent paper from the Center for Retirement Research at Boston College as well. So you kind of get the worst of everything. You don't get the outcomes you had hoped for, and you're getting lower returns on those investments.
Thanks, Tom. And it has been really encouraging to see so many people picking up on this new model policy. Just before Memorial Day, former U.S. Vice President Mike Pence had a piece in the Wall Street Journal outlining the merits of this model policy and what it could mean for the states. But one important thing in this report, we like to focus on the reforms. We've talked about a couple of reforms going back 10, 15 years. We've talked about some threats to undo those reforms. But if you had to break it down, Jonathan, for someone looking at this new report, our 6th edition, and seeing this dire situation that so many states are in, what can they do today? Or what steps should they start taking to address this issue of growing unfunded liabilities?
Well, there's a lot to be done there. I mean, first of all, when you're in a hole, the first step is stop digging it deeper, right? And so right now, states are in a historically strong position when it comes to cash flow. There's a lot of money sloshing around state capitals right now. And one of the things that can be done with the natural revenue growth from the state level, at least, is to pay down current unfunded liabilities. And it's definitely an anti-inflationary move too. And something as you pay down debt, I know Arizona, for instance, working with Senator Vince Leach, is something that he worked on, even as they were cutting taxes dramatically and making Arizona a much more competitive state. He also, I think they put another $1 billion towards paying down unfunded liabilities. And so if states decide they want to keep a defined benefit plan, it's going to be very expensive over time. It's going to be riskier over time on behalf of taxpayers, but they can put more dollars to pay off those unfunded liabilities. And then, looking at the structure, this is something that we've talked about with many of the success stories in the states where we've seen states really improve upon their unfunded liability status is by transitioning new hires to more of a hybrid or cash balance or defined contribution type approach that many of those successful states have done. And then finally, the governance piece of it, which is what we were talking about when it comes to the politically motivated investing, is tightening up statutory rules model policy or putting real rules in place. For instance, the Kentucky Attorney General and the State Treasurer Allison Ball and Attorney General Cameron just had a good piece pointing to Kentucky's law that requires a state to invest with the sole beneficiary in mind of pensioners. And so taking a look at the fiduciary type rules, making sure that people that sit on pension boards are qualified and have financial experience, things like that. And to make sure that, let's say, state pension systems aren't voting the shares of those plans against the interest of their state. This is something that our friends at Texas Public Policy Foundation just uncovered, that some of the, ironically, the Texas retirement funds, the pension for the teachers, as well as other plans, had voted against ExxonMobil's management and for kind of a radical Green New Deal style slate of candidates that then some of them won the ExxonMobil board of directors elections. And so we're seeing, even in conservative states, if it can happen to Texas against oil and gas, where these funds are voting the shares, whether it's based on the pressure of the unions or other pressures out there, there's a lot of work to be done. So funding, structure, and governance, those are the three areas to take a look at.
And for all of our viewers right now, we're going to have a moment for questions. If you've got one, feel free to submit it in the chat box. Before we get there, though, Tom, Jonathan talked just now about some proactive measures that you can take. What would you say are pitfalls to avoid? I know you've talked a lot in the past about states that have worsened over the past 6 editions of this report. Are there obvious mistakes that states need to avoid making to worsen their existing problems?
Certainly. Oh, sorry there. I didn't mean to raise my hand, but yeah, there are certainly a lot of things to avoid. And as we've emphasized throughout the call, it's, avoid these politically motivated investing strategies. That is just a danger to pension assets and an easy way for liability growth to outpace asset growth. And another pitfall to avoid is pension obligation bonds. It seems like a good idea. It's very tempting with, especially in times of low interest rates, to say issue bonds and then take the revenue you earn from selling those bonds and putting them in the pension fund, and then trying to beat the market and have investment returns be greater than the interest you owe on these bonds. Infamously, the states of Illinois and Connecticut tried doing this and were hoping to ride market returns up, but the year was 2007, and shortly after that, the market crashed, but they still owed the money on those pension obligation bonds. And the same, similar and even worse case happened in Puerto Rico, where even with decent market returns of the past decade, before 2020, issued that pension obligation debt and couldn't beat the market, and now they were on the hook for both unfunded pension liabilities and additional bonded debt. So as much as tempting as it seems, if something seems too good to be true, it probably is.
And one thing to jump in on that, and those are good points, Tom, is a couple of other things going back historically, looking at pensions, and in decades past, pensions were generally, since they're defined benefit, in many cases they're protected by property rights doctrine, contracts clause type work, or even constitutional protections. They invested in very low risk investment opportunities, such as bonds, for instance, government bonds that had a low upside, but also had very low risk of default. But over time, as the pension plans got, let's say, less funded, and the annual required contribution would get diverted into whatever the political issue of the day lawmakers wanted to invest in those states. And then they found themselves, as you pointed out, in a scenario where they're chasing returns and investing in riskier and riskier assets, where of course then the 1990s provided states options to really chase the tech boom in the 90s. And of course that came back to bite states big time when that bubble burst. Another thing around that point in time, though, when things were so good for states, an unforced error, and this is really relevant to today, is all of us seeing, retirement earnings, retirement power decline now with massive historic inflation, thanks to the big government agenda here in Washington, D.C. and Federal Reserve actions. But that being said, so many of the states enacted COLAs and retroactive COLA changes back in the early 2000s when they were flush with cash and pension funds were in many cases on paper overfunded. And then they made these changes that became very expensive. And while all of the private sector retirees and 401ks are worrying about inflation right now, many of the public sector plans have the COLA protections that are very expensive for all taxpayers, but do protect retirees in the public sector side.
And we do have one question. Tom, I'll let you take the first crack at it. This comes from one of our viewers. Is there any way out of the hole for California and Illinois?
Yeah, it's painful, but absolutely necessary. I think one for California is to avoid politically motivated investments. And of course, it's, as we mentioned, switch to defined contribution for new hires, because as Jonathan mentioned, there are various legal protections for pensions throughout the country, and trying to adjust those may lead to what might be considered a breach of contract. But when applying them to new hires, a defined contribution system really can't be beat. A couple months ago, actually, the Bureau of Labor Statistics came out and found again that the average number of jobs for young Americans held between the ages of 18 and 30 are 8 jobs. And to put that into perspective, previous generations had a total of maybe 12 jobs over the course of their lifetime. So between the ages of 18 and 30, there's 8 jobs. At least half, if not more, of those jobs are held between the ages of 18 and 25. So a defined contribution system really allows those retirement savings to follow a young worker wherever he or she goes. It's instead of saying, leaving a job and then not vesting and all of that money getting put into a pension system that you're not going to see a dime for. It's better to have that 401k and to be able to have your retirement savings follow you. At the same time, as Jonathan mentioned, it protects from politically motivated investing, because the investment decisions with a defined contribution plan like a 401k or a 403b, a 401k plan, is that the investment decisions are made entirely by the owner of the account, the public employee. And if they want to make some politically motivated investment decisions, that's on them. But for everyone else who just wants to build their nest egg, everyone else is not affected by one person's decisions.
Thanks, Tom. Excellent points. And we're reaching the end of our call here today. I wanted to just say, though, if any of our viewers, anyone watching this has questions, we'll drop the contact info for myself, Tom, and Jonathan in the chat box. We'll also be releasing the full edition of this report on Thursday morning, so please keep an eye out for that. But before we sign off, Jonathan, I wanted to give you a chance to give the final word and maybe leave the viewers with one thing that you want them to take away about this report.
Well, I'll tell you what, this is some big, dangerous numbers here. There's no doubt about that. There's a lot of work to be done and across the states. I mean, now's the time to do it, though, when states have a good cash flow sitting there to do what Arizona did and start to pay down the liabilities, or to look at things like Michigan and Alaska and Oklahoma and Utah and Wisconsin and others that have made real changes within a relatively short period of time for their states. I mean, we talk about these issues as, these are 40-year problems that have been building in a lot of cases, but it is really remarkable, notwithstanding the real problems in Illinois and California, some of the others that are going to take a long time to dig out for. There's no second way of questioning that. But that being said, is in a relatively short amount of time, just dealing with new hires coming into the system to honor the promises that have been made, to give young workers that, as Tom points out, are going to have many, many career opportunities that don't want to go through these complicated government vesting systems, giving them that choice and that flexibility and having their own assets to move with them from opportunity to opportunity. That's a game changer. And once again, not just theoretical, but states that have gone down this path have seen real savings in a relatively short amount of time. So there is hope. The numbers are daunting. It's going to take hard work. It's going to take real leadership across the states to do it, but it can be done based on our work and based on the leadership of all the ALEC members across the country.
Well, I couldn't have said it better, Jonathan. Honor the promise, protect taxpayers. I want to thank everyone for joining us this afternoon for our preview call of Unaccountable and Unaffordable, the 6th edition. As I mentioned, the full report will be released Thursday morning. You'll be able to find that at alec.org. If you've got any questions between now and then or in the future, please don't hesitate to reach out. Please share this report with your colleagues. And thank you again so much for joining us. We hope you have a great day.